Hello, everybody. Welcome to Hell's Trading Floor. My name is True Demon, the Devil's Stockbroker, and here today I'm going to discuss with you what in the hell happened in the market today. Dear God, I've rarely seen such a freaking bloodbath, and I don't even think that the May 18th collapse that happened earlier this year even comes close to just how red the market is today. Let's get some of the news out of the way first things first. So earlier this morning on August 26th, Fed Chair Jerome Powell earlier today spoke at the Jackson Hole Symposium, which is an annual retreat slash conference for the finance world that occurs in Jackson Hole, Wyoming. And typically, this is a instance for the Fed to describe its policy actions and expectations for the future and discussing the outcome of financial markets across the world. But this year is a little bit different. This year, we've been discussing what exactly is the Fed going to do with the situation that they face right now in the current financial markets. How are they going to tackle inflation? And what are they going to do with the rate hikes going forward into 2022 and 2023? So first, let's go get some of the TA out of the way. All right. So from the top of the SPY, which was trading at well, this is XPX, excuse me, about $4,800 per share of SPX. We've seen some serious ups and downs, with the lowest low coming down on the 16th of June at a low of 3,639 and 77 cents. And we've had this massive rally that I have talked about being a big suckers rally. It went on way longer than I expected. I definitely should have played it a lot more aggressively than I did. I should have gone long early on when I knew that it was going to rip to the upside, but even still, I never expected the market to pull quite the same move as what it did today. So the Jackson Hole Symposium is where this all began. This great big red candle that you see here, this absolute monstrosity of a candle, which cannot even be compared to any of the previous gap down candles or even this candle. It actually exceeds the candle of May 18th and even May the 5th, which both of these both of these were, quote, bloodbaths in the market. So this marks the first huge death candle of the market downturn. And most traders that I had been paying attention to were taking note of this area of support here that was created during this diamond top pattern. And we knew that we were trading in a head and shoulders, right? So we naturally expected to at least get a little bit of distance in this latest run. But instead, what we got was a great big fake out and huge dump to the downside. This head and shoulders pattern developed and completed so quickly that now I see nothing but downside all the way back down till around the 4,300 or 4,000 and the 3,900 price level. So somewhere in this area is where I expect us to find a little bit of support for the chart going forward. Now, the market is in huge turmoil right now, and even as you can see on the right of my screen, my entire watch list is red. And I did play puts against Apple, the NASDAQ, SPY, Microsoft, Nvidia, Tesla, you name it. If it's on this side, I've basically played it, with perhaps the exception of Google and Meta. Um, all of the red that you see here has my portfolio surprisingly green. The only thing that did well that is extremely green in my charts right now is inverse ETFs that are tracking the major indices. And shockingly, I have never seen a double digit yield on any of these, but double digit percent change for SPXU, uh, just absolutely incredible move from this inverse ETF. Now the thing is I was not expecting this move today. I wasn't expecting the SPX to get hit so hard. And I see so many people are confused right now. Everybody was kind of expecting Jackson Hole to be like, oh yeah, the Fed's gonna, throw a lot of wind into our faces. They're gonna bluster a little bit, and they're going to talk about, you know, the inflation rate needs to be fought, yada yada yada. And I heard this consistent commentary of everybody saying that Jerome Powell said at the symposium, a big nothing burger, just absolutely said nothing of interest. It was the same speech that the Fed has given repeatedly before, but there's some subtlety in his language that tells a very different story. Things are actually going to get much worse for the market, and I'm anticipating that a lot more pain is coming than what people realize. So, in order to get ahead of this, I'm going to actually interpret Fed Chair Powell's speech, and I'm going to walk us through exactly the language that he chooses to use right now.
Thank you, Peter, and good morning, everyone. Esther, thank you very much for the opportunity to speak here today. At past Jackson Hole conferences, I have discussed broad topics, such as the ever-changing structure of the economy and the challenges of conducting monetary policy under high uncertainty. Today, my remarks will be shorter, my focus narrower, and my message more direct. The Federal Open Market Committee's overarching focus right now is to bring inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all.
So here, what Jerome Powell has stated very clearly is the same thing that the Fed has been speaking of in the past, that inflation is out of control, it needs to be brought back under control, and that the Fed is going to do everything they can, blah, 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 that's their job. Yeah, we know. We understand, Jerome. But there is a shift in his tone, and there is a major shift in the use of language that he uses from this point forward in the speech. Right now, he has established the gravity of the inflation situation that we've seen recently. This, however, is where things change.
The burdens of high inflation fall heaviest on those who are least able to bear them. Restoring price stability will take some time and requires using our tools forcefully to bring demand and supply into better balance. Reducing inflation is likely to require a sustained period of below-trend growth.
So right here, this is the last thing that bulls wanted to hear coming from Jerome Powell. What he's referring to here is sustained suppression of growth. Just recently, we printed a third consecutive quarter of negative GDP growth, which if two consecutive quarters, even if the White House decides to just change the definition of what a recession is and say that 2 quarters isn't a recession, well, 3 definitely is, okay? There's no excuse anymore. We have to admit to ourselves that we are in a recession. And on top of that, we're in a recession in the midst of a major inflation crisis, which has ripping out of complete control, and the Fed has no ability to fight the inflation without causing immense pain in the market. And what everybody was banking on was for the Fed to pivot soon, not like this year, but sometime in 2023. When he refers to sustained, anytime the Fed starts talking about sustained suppression of growth, they're talking about years of it, not just a few quarters, not a few months. We're talking about years of sustained high rate of interest from the Fed.
Moreover, there will very likely be some softening of labor market conditions. While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation. But a failure to restore price stability would mean far greater pain.
So the specific target of this is corporations which require renewal of debt in order to keep sustaining their businesses. This is one of the things that other companies are actually looking for that they have been most worried about. And interestingly enough, Apple got ahead of this situation because they foresaw that in their future they were going to need money. And interestingly enough, Apple sold bonds in their company in order to raise capital by taking on debt from shareholders and bondholders. What Apple did was perhaps the smartest move that they could have possibly made, because at that exact moment, Apple's share price was almost indistinguishable with what it had been during the majority of 2021. Apple's share price has skyrocketed to areas that it had not imagined seeing for the next 5 to 10 years. And the fact that it's here now gave them a great opportunity to sell bonds, take on debt from new bond holders because they knew that this language, this was coming from the Fed, that the Fed is going to raise interest rates and restrict the monetary policy so high that new debt is not going to be attainable for a reasonable interest rate. And they made this move before the Fed started getting truly aggressive because that would have caused the rate of interest, as in the risk of their bonds, to go up. Right now, Apple has AAA bonds, which is they're one of few, three companies in total, I think, between Microsoft and Johnson and Johnson, I believe, that have AAA rated corporate bonds. It's a rare thing in our global equity markets. So now all the risk in the market is going to come tearing down at everybody with highly leveraged debt with that are exposed to high rates of interest and have no cash on hand and need to go get a loan. Those companies that are out of options, out of money, are going to be at most risk here. And this is what the stock market is hating right now about the statements being made by Fed Chair Powell.
The U.S. economy is clearly slowing from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. While the latest economic data have been mixed, in my view, our economy continues to show strong underlying momentum. The labor market is particularly strong, but it is clearly out of balance, with demand for workers substantially exceeding the supply of available workers. Inflation is running well above 2%, and high inflation has continued to spread through the economy. While the lower inflation readings for July are certainly welcome, a single month's improvement falls far short of what the committee will need to see before we are confident that inflation is moving down. So, we are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%.
There are two things that he says here specifically. One, he notes the strength of the labor market, and interestingly enough, the labor market showed it strengthened in the last month when they reported the latest unemployment numbers and job participation rate, which I honestly believe that the numbers are fixed and it's not a reflection of reality because right now worker participation is and sentiment is at all-time lows right now. Participation in the job market is counting among them people that hold multiple part-time jobs, which is a fallacy because you have one person that might be adding 2 to 3 people's worth of participation in the figure. So it's very easily skewed. And I think that it actually does not accurately reflect the job situation or the employment situation. But nevertheless, the market read of it based on the jobs, the labor statistics data that's given to us from the Bureau of Labor Statistics is saying that the job market is strong. Demand for jobs is extremely high, and there's not enough workers, and yet somehow we have high worker participation. And the thing is that there's the majority of these are empty seats from zombie companies and companies that are trading on the SPY that aren't really generating real money. And not necessarily just the SPY, but I'm going to use it for this example. These companies that are not generating any funds and rely on constant influx of employees is not real. And I'll tell you why. PPP loans. I've talked about this several times, but PPP loans, which is the um, loans that all of the federal banks and the U.S. Treasury were giving out. The government was basically printing free money for companies in order to encourage them to keep employing people. So they gave them a paycheck replacement loan. That's what the PPP loan does. It replaces paychecks because those companies weren't able to be profitable during the pandemic. And they're still issuing cash, one. Second, they're also forgiving these loans, which is absolutely asinine. And three, all of these companies were taking advantage of it because the companies were incentivized to just post help wanted signs, and that was all that was required to qualify for the PPP loans. They were able to just simply state that they were going to keep hiring people and they needed the money to sustain business operations. That's all you had to do. Rubber stamp, accepted, you get your money, next to no interest, and we will forgive the debt later. Well, guess what? Those companies left their job postings up and they're still not hiring people because they kept the money for themselves. There's multiple stories out of people just constantly pulling money out from these PPP loans and all the executives, the owners of single member and partner level LLCs, they're all just taking in this free money and running away with it, and there's no consequences. And all they have to do is just keep a help wanted sign up in their window and say, "But I can't find anybody." So the job participation rate and the job demand is not matching up with reality. All of these numbers are completely skewed. And because of that, the Fed is totally wrong about the employment situation. But this is the number that they're using to justify their rate hikes. And as long as the employment numbers are high, and unemployment remains low while job participation is rising and job demand is rising, they're going to keep slamming everybody with these interest rate hikes. Now, I personally believe that it's necessary in order to bring the market into balance and in order to get inflation under control, but the market is going to hate it, and it's going to cause a massive decline in the equity market for the next at least 6 to 12 months, but probably going on to the next 2 and maybe even 3 years.
At our most recent meeting in July, the FOMC raised the target range for the federal funds rate to 2.25 to 2.5%, which is in the Summary of Economic Projections range of estimates of where the federal funds rate is projected to settle in the longer run. In current circumstances, with inflation running far above 2% and the labor market extremely tight, estimates of longer run neutral are not a place to pause or stop. July's increase in the target range was the second 75 basis point increase in as many meetings, and I said then that another unusually large increase could be appropriate at our next meeting. We are now about halfway through the intermeeting period. Our decision at the September meeting will depend on the totality of the incoming data and the evolving outlook.
Okay, so this is what scares the absolute shit out of everybody. He said unusually high rate hike. The unusually high rate hike is 75 basis points or more. And one interesting fact is that when you compare our rate of interest increases in the United States versus all of the other European markets, is that we are actually slower than the rest of them. The rest of the world has done at least one 100 basis point hike. And we've already done 175 basis point hike for the federal funds rate, but the 100-point hike has yet to come. And it's the thing that the equity markets fear most because it means absolute Armageddon as far as being able to take out fresh loans and equity. And it puts an extremely heavy weight on the shoulders of the banks in terms of their ability to stay liquid and issue cash and loans out to borrowers. And that prevents the equity markets from being able to run smoothly and to keep pushing stock prices up. So that fear, that worry, that concern of another 75 basis point hike is scary enough that it can cause a massive drop just like this. And now, here's the thing. Everybody was anticipating a 50 basis point hike. The market was pricing in a 60% chance of only 50 basis points. Some people were speculatively saying 25 basis points. But honestly, I think that's in the realm of delusion because the Fed can't slow down. They're in a position where they are unable to because right now they are so far behind on inflation. And historically, the Fed has never been able to fight inflation until they have brought the effective federal funds rate above the inflation rate. So when we talk about above the inflation rate, we're talking about the Fed raising their current federal funds rate from the existing 2.5% all the way up past 8%, more than a 3.5 times increase.
At some point, as the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. Committee participants' most recent individual projections from the June SEP showed the median federal funds rate running slightly below 4% through the end of 2023. Participants will update their projections at the September meeting.
So he's now given us a date that the continued rate hikes are going to go on until the end of 2023. Most people were expecting that the Fed was going to pivot by the end of spring 2023 at the latest. And what he has just stated here is that no, expect rate hikes to continue all the way through the next year. There's going to be punishment, there's going to be pain, and you need to be ready for it. He's not mincing any words here. He's not playing nice, and he's not being gentle about it. The market is out of control and continuously going up in spite of all of the pressure that the Fed has been putting on the market. And the fact is that inflation is still not moving down fast enough. The inflation numbers came down once, and that was enough to make the Fed at least hopeful, but it's not enough to stop them from engaging their policy and their requirement to keep inflation under control.
Our monetary policy deliberations and decisions build on what we've learned about inflation dynamics, both from the high and volatile inflation of the 1970s and 1980s, and from the low and stable inflation of the last quarter century. And in particular, we're drawing on three important lessons that I'll highlight. The first lesson is that central banks can and should take responsibility for delivering low and stable inflation. It may seem strange now that central bankers and others once needed convincing on these two fronts, but as former Chairman Ben Bernanke has shown, both propositions were widely questioned during the Great Inflation period.
So Fed Chair Powell is actually taking a shot at Bernanke, who was actually in charge of the Fed during the 2008 fiscal crisis that struck the housing market and put us in the situation that we are in today, where the Fed basically had to drop the federal funds rate next to nothing, and that caused the hyperinflation to extend. Now, we didn't have the inflation get out of control wildly until the COVID pandemic. That was when things got absolutely out of control. But we recognize that things were getting more expensive for people, and we also should recognize that honestly, the CPI, the Consumer Price Index, is not accurately tracking inflation. The reason why he is referencing Bernanke here is that he's taking lessons from the actions taken in 2008 and the the unrestrictive policy, or the very liberal policy that was taken at that time, was meant to address a very specific issue in the market and keep people from losing their homes wholesale and allow banks to stay functional throughout the great financial crisis. But he's also recognizing what a mistake it was, because the banks got themselves into that situation, and once given a blank check to save themselves, they chose, rather than continuously propping up their operations and dedicating to refining their entire business model, they instead took bonus checks.
Today, we regard these questions as settled. Our responsibility to deliver price stability is unconditional. It is true that the current high inflation is a global phenomenon, and that many economies around the world face inflation as high or higher than seen here in the United States. It's also true, in my view, that the current high inflation in the United States is the product of strong demand and constrained supply, and that the Fed's tools work principally on aggregate demand. None of this diminishes the Federal Reserve's responsibility to carry out our assigned task of achieving price stability. There is clearly a job to do in moderating demand to better align with supply. We are committed to doing that job. The second lesson is that the public's expectations about future inflation can play an important role in setting the path of inflation over time. Today, by many measures, longer-term inflation expectations appear to remain well anchored. That is broadly true of surveys of households, businesses, and forecasters, and of market-based measures as well. But that is not grounds for complacency, with inflation having run well above our goal for some time. If the public expects that inflation will remain low and stable over time, then, absent major shocks, it likely will. Unfortunately, the same is true of expectations of high and volatile inflation. During the 1970s, as inflation climbed, the anticipation of high inflation became entrenched in the economic decision-making of businesses and households. The more inflation rose, the more people came to expect it to remain high, and they built that belief into wage and price decisions. As former Chairman Paul Volcker put it at the height of the Great Inflation in 1979, inflation feeds in part on itself, so part of the job of returning to a more stable and more productive economy must be to break the grip of inflationary expectations.
Fed Chair making a reference and his repeated admiration of Fed Chair Paul Volcker, who was the only Fed Chair to face a possible hyperinflation scenario in the United States ever in its history, and the only one to successfully do it, is basically a nod to every single person in the market who is watching him right now that he's going to take the same stance as Paul Volcker did in the 70s. This is going to scare the absolute shit out of the markets. And I will just briefly show you what that chart looked like at that time. In the 1970s, when inflation was running absolutely rampant, the Federal Reserve at that time in the early 70s took a stance of bringing up the federal funds rate to a rather high level, and it did cause a massive market crash. In fact, the market had declined by more than 50% at the time from its high on a month-over-month basis. Now, the thing is that the Fed pivoted right away as soon as the pain became too great, and the market recovered immediately, bouncing off of its 200-period monthly moving average. and the market roared back to where it was only about a year and a half later. However, as inflation became priced in to the market, and as companies continuously were constrained on the rising costs of doing business, while even though inflation wasn't necessarily going that high, it was because it had become entrenched in the mindset of the American people because inflation remained high for a full 2.5 years. And it was so excessive that it brought everybody up to this idea that inflation is never going away. We should just assume that it's going to be there forever, and we should price it into everything that we do. But it became so restrictively expensive, nobody was able to afford a home, nobody could get a loan, nobody could start a business, and it caused the economy to completely recess into stagflation. And that resulted in massive job losses with simultaneously high inflation, and things were absolutely miserable. When the Fed pivoted for the second time in order to go full hawkish, they brought the federal funds rate up to a full 20% to get inflation under control in the late 70s through the 80s, at which point it brought inflation down hard, but the market, as you can see, moved absolutely nowhere for the entire duration. The market from that time moved down to 25% from its high, and it more or less had stayed there, ranging only about 20%. Nobody was making money, nobody was investing, and nothing was happening. There was no way that you were going to make yourself rich in the stock market during the 70s and the early 80s. It just wasn't going to happen. And this is exactly what everybody else is afraid that Fed Chair Powell is going to do if he takes this same stance and he keeps making references to Volcker, which is why he is doing it. He is trying to scare the absolute living shit out of the bond market because he knows that what this is going to do is drive the bondholders to move over to long-term bonds, and everybody is going to get extremely quiet and safe and turtle up, and the economy, the equity market, is going to drop. And sure enough, as soon as he started saying these things, that's when things took a turn to the downside. We were only exactly 5 minutes into his speech at the time that things started to get absolutely ridiculous. The moment that he stepped onto the podium, things went down and then shot back up within 5 minutes because everyone was like, oh, he's just saying the same things that he's always been saying. And then the moment that he concluded with that Paul Volcker comment, things started to go downhill in a freaking hurry. And from that point on, the market was only sell, 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 sell. And there's no going back from it at this point.
One useful insight into how actual inflation may affect expectations about its future path is based in the concept of rational inattention. When inflation is persistently high, households and businesses must pay close attention and incorporate inflation into their economic decisions. When inflation is low and stable, they are freer to focus their attention elsewhere. Former Chairman Alan Greenspan put it this way: for all practical purposes, price stability means that expected changes in the average price level are small enough and gradual enough that they do not materially enter business and household financial decisions. Of course, inflation has just about everyone's attention right now, which highlights a particular risk today. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. And that brings me to the third lesson, which is that we must keep at it until the job is done. History shows that the employment costs of bringing down inflation are likely to increase with delay as high inflation becomes more entrenched in wage and price setting. The successful Volcker disinflation of the early 1980s followed multiple failed attempts to lower inflation over the previous 15 years. A lengthy period of very restrictive monetary policy was ultimately needed to stem high inflation and to start the process of getting inflation down to the low and stable levels that were the norm until the spring of last year. Our aim is to avoid that outcome by acting with resolve now. So, these lessons are guiding us as we use our tools to bring inflation down. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply and to keep inflation expectations anchored. We will keep at it until we're confident the job is done. Thank you.
So basically, to wrap up everything that Fed Chair Powell there's no other way to say it. He's basically telling everybody in the market, you need to be prepared for a Volcker-style response before we need to get that aggressive. So the Fed's policy right now is to actually start kicking things into gear and actually start moving against their balance sheet and selling things into the market. There's one specific thing that he was referencing, especially with Alan Greenspan, was the idea that things getting priced into the market and allowing it to stay there is going to create more problems on down the road. And he did make a very specific note of Alan Greenspan, who was basically the architect of the global financial crisis because of how how relaxed the monetary policy was and how strong he made the housing market. Some of the policies that Alan Greenspan, when he was at the Fed, moved into, or rather moved the federal bank into, in order to ease the credit lending standards for housing, it literally caused the great financial crisis because it took all oversight over the mortgage lending standards and incentivized banks to lend and lend and lend as much as possible and write mortgage-backed securities because the Fed would buy them. And the thing is that this caused the banks to get extremely out of hand with lending out money. And what this translated into was very easy credit, and everybody could get a house, and they couldn't afford it. Nobody that actually got a house was in a position that they would be able to actually pay off their mortgage down the road. There was fraud and things like that going absolutely rampant in the market at the time, and that caused the housing market and the pricing of houses at the time to go absolutely ballistic to historic levels that we hadn't seen until recently with COVID and the massive surge in housing prices and the median housing cost rose during that time. So, because we're in the exact same situation, I have a feeling that Fed Powell decided that this was an appropriate time to bring up the failure of Alan Greenspan to because he actually created that situation and allowed inflation of the housing market to lead to a massive surge in the cost of housing, which put more pressure on people that were determined to get a home no matter what, that they would lie on their stated income statements, and all the banks were just lending money nonstop. And that led directly into the great financial crisis when the housing market was literally unable to be propped up because it was held up by all these terrible loans. And we're going through a very similar situation right now. And you may say, but the lending standards are great. The housing market can't go through that again. There's no way that that could happen again. Well, actually, there is. Because when you consider that more than 30% of all of the homes and the house price rising that happened recently was because of extremely well collateralized real estate investors. Yes, Wall Street investors are the reason why the housing prices were just absolutely soaring. And this has caused a complete imbalance in the housing market. And he has stated in a previous speech, Jerome Powell said, if you are if you're one of the younger generation and you're looking to buy a home, you need a bit of a reset. He means that the housing prices are too high, they need to come down, and inflation is driving it. And the worst part about inflation in the housing market is that it's sticky. It stays there. Housing prices are generally believed to only go up. And this is the fight that Jerome Powell has ahead of him. So he knows that if he's going to fight this, the way that he has to fight inflation is to attack banks directly and hinder their ability to lend money continuously the way that they have been and allowing this to continue. Because if it goes on and if the housing prices continue to soar and get even more out of control, it's only going to cause inflation to get even more out of control because the problem with inflation in housing is it causes rent prices to go up because as soon as the guy who just bought the house, the investor that just bought the house gets it, he wants to rent it and he wants to recoup his money immediately. So he starts raising prices and that causes other people to raise prices, which causes other price raises and so on and so on. And it feeds upon itself. It's like a monster eating its own tail and it's out of control. It's been out of control. I would like to briefly end on this one chart, which should say absolutely everything that you need to know about what we are in for when it comes to inflation, because the housing market is one of the biggest drivers of it. In 2003, the Fed eased policy in order to help us get out of the funk that the market and the entire economy was in the wake of the dot-com crash. Now, this was necessary for a time, but it was allowed to go on for a bit too long. And on top of that, Alan Greenspan relaxed the lending standards so much and encouraged banks to issue out all these faulty loans by basically giving them a blank check by selling or by buying their mortgage-backed securities at obscene rates in order to stimulate the economy. He essentially created a situation where banks could keep lending nonstop, just like I explained. This caused the prices of homes to rise massively, but simultaneously, people who were trying to get them were getting issued bad loans because they could never, ever possibly afford to pay them back. The banks didn't care because they weren't carrying all of the risk until suddenly they had a glut of them stuck on their books that they couldn't move, and they were all going default at the same time. Now, what ended up happening was the prices of homes hit their all time high, rising 36% in just 5 years. It took 5 years for them to reach their absolute peak. And after they started to go into decline, the banks were holding on to all of these worthless mortgage backed securities and equity that they couldn't get rid of, and people were defaulting on their homes. And this caused everybody to run out of their homes. Everybody started selling at ridiculously rapid paces. And this inevitably led to the crash, which finally struck in September of 2008. Now I'm going to add inflation to the chart, and you're going to see how long it stayed around after the housing crisis. As soon as housing had begun to rise, inflation started trending upward in a massive way. Inflation was going at a pace of, from the bottom of 2002, in July of 2002, where inflation was at roughly 1.2%, it managed to reach a peak of 4.7% in October of 2005. And then the cost of living got too much for average Americans, especially the impoverished and the low income who were buying homes that they couldn't afford. And this translated immediately into foreclosures and defaults that went on for the next 2 years through 2006 and 2007 until finally the subprime crash in June caused a bunch of mortgage lenders to close their doors, which is happening right now today. Mortgage lenders of Lending Tree and Century Mortgages are in such a bad state right now. They're running out of cash. They're not going to get bailed out because they can't. They're not one of the big banks. They're just a mortgage originator. They're going to be stuck with all of these bad loans that they're not getting paid for. And then inflation sticks around. And it wasn't until everything was just basically wrote off with a blank check that inflation finally came back down. But it stayed around for a full year thereafter. Now, because the inflation was related to the housing market and because the crash happened so quickly, things were fixed relatively quickly. However, this is different. We're experiencing inflation across all commodities, across all sectors, and it's being led by the housing market, which today is up 35% in 2 years. Not five, but two. Now that you've had some time to process this, I hope that you can understand a little bit more what the gravity of the words of Jerome Powell actually have for the state of the market going forward. In another video, in the future, I will be covering some additional plans that I have for how to play this. But for right now, I would like you to just digest this information, consider it, and really consider what is going to be happening in terms of the monetary policy going forward, because this is going to have a direct impact on us, whether we are working for big institutions or not. This is going to trickle down. It does eventually reach us. The the stuff rolls downhill, as they say. For the time being, what I will leave you with is expectations to see the market continue to contract, going down towards the $390 level on the SPY, and find support in this area that we have seen in the past. It's likely that the price will probably hang around there for a while, at which point I'll be planning on closing out most of my short positions and then waiting out the chop to see where things go. I'll be holding on to some long distance ones for a greater duration. It is not certain if we'll get a quick bounce or not. We'll have to trade the chart that's in front of us. But following any chop of any kind, I'm eventually expecting the market to fall down all the way down into the panic zone below $340, and could go anywhere near as low as 300 in the market if things truly get excessively scary for market participants. For right now, my short plays is basically anything that's in the tech sector, anything that is dependent on semiconductors, technology, and especially anything that is in finance or tied to the housing market in any way. REITs, especially, I expect to perform very poorly going for the rest of the next 2 quarters to the end of the year. Defensive sectors like consumer defensives and consumer cyclicals, the necessities that people need, foodstuffs, as well as energy and oil, I expect to go up. And inflation, I anticipate, will still be high going forward into the next CPI data print. Whether or not inflation continues to go up, I still expect oil and energy to get more expensive. Ergo, I'm going to be long on US oil, anticipating that oil could be seeing highs as high as $110 in the next 3 months, as well as ExxonMobil, which you can also trade according to the XLE index. But for right now, I am tracking ExxonMobil. I'm anticipating ExxonMobil to eventually reach my price target of $120 at some point within the next 3 months. As well, XLE, which is a little bit cheaper if you can't afford contracts or don't want to spend as much money with ExxonMobil. XLE has a very similar print of a very large bullish pennant that you can see printed right here, and it is essentially breaking out to the upside. I anticipate XLE to be able to reach at least $96 within the next 2 quarters and could go as high as $112 by the end of the year. That's going to be it for this video. Thank you so much for watching, and I hope to see you in the next one. Until then, have a hell of a time in the markets.